Thanks, Carrie, and welcome everyone. It was great to see many of you last week at the ACEC Fall Conference, and we're excited to share with you some additional data. Some of this was released at the Fall Conference, but we want to dive a little bit deeper into it today through another installment of our Future of Engineering Roundtables. So first off, I want to thank our donors who make this research possible, these webinars possible. And I know many of you are actually on the call today, so thank you for your continued support. I am joined today by my colleague, Joe Bates, who serves as the lead researcher at the ACEC Research Institute. And I think we're just going to go ahead and jump right in, Joe. You got a lot of good stuff. I know the markets are going crazy today. You're mentioned earlier you're keeping an eye on those. So let's go ahead and jump in and see what you have for us today.
All right, great. Thanks, Daphne, and welcome everybody. I'm glad to be here again with you all. We have, as Daphne said, quite a bit of good information for you all and some commentary that I'll provide along the way. Today, we're going to go over our usual agenda. Those of you who are familiar with this webinar will recognize this. We're going to talk about, just to set the stage here, what does the engineering and design services industry mean to the U.S. economy, just a quick profile snapshot. Then we're going to look at how is the economy doing today, then how is the AE industry doing, and we're going to take a sneak peek at the future and see what we can divine between the tea leaves today. So with that, we're going to get started. What I'm about to show you is brand new information. We are going to do another roundtable in just a couple weeks on November 15th, which is going to dive into a whole lot more updated information about our economic update and forecast. So I'm just going to show you a little bit of a preview of what's in that study to come. This is something that we've updated from last year. So you can see 2021 numbers. That's the last full year for which we have data in terms of AE industry revenue. So we are at $373 billion in revenue in 2021. And that was a nearly 10% increase over 2020. Of course, 2020 was our pandemic year. So it's good to see such a robust and healthy industry recovering as we have. It really only took a few quarters for the recovery to occur in terms of all those revenue dollars. And we're doing very well right now. In terms of the contribution to the US economy, there's a multiplier effect. Essentially, for every dollar that is spent or realized in revenue in the industry, there's a 1.5 multiplier in terms of economic contribution to the entire US GDP. So that's at $500 and nearly $60 billion. And that's a huge increase over last year as well, over 2020. And you can see there's direct effects, which is what is in this industry. So the wages you pay your workers, the wages you receive as a worker, rents that you have to pay, etc. That's the direct industry GDP number. And then we have induced and indirect effects, which are sort of trickling down through the rest of the economy. So when you use your salary to pay your own mortgage, that's going into the economy in an indirect fashion. So lots of good news here. Jobs grew to 4.7 million. That's about a 200,000 increase over the prior year. So again, this is total AE supported jobs, not just within the industry. Within our own industry, we're still at about 1.5 million. That's been fairly stable between 2020 and 2021. And we'll talk more about jobs later. And of course, we have a lot of contribution to tax dollars. So really good news about our industry. And this is who we are. In the report, we have a lot more information. And I just wanted to show you one slide. We have all of that data in terms of GDP, jobs, tax revenue by individual state. So you can go use that report today and use it for your own company, use it for any advocacy you might be doing within your state legislature. But we have tons and tons of great information in that report. And that is available now on the ACEC Research Institute website. Okay, so let's take a look at how we're doing in the economy right now. So we haven't received third quarter data yet from the Bureau of Labor Statistics. So we're waiting on that, but we already know that we had 2 negative quarters of GDP. This was a surprise in the first quarter of the year. Nobody was anticipating we would have negative growth in the first quarter, but we did in the first quarter and the second quarter. A lot of that didn't really have to do with the substance of the US economy. There were increases in exports, and when you increases in imports. When you buy things outside the country, you're sending money outside of the country, and that actually deducts from GDP. So we had some of that. We had some supply chain issues. There were a few problems within the economy itself, but this is a really weird time we live in. It's an anomaly in terms of the economics of the last 100+ years. We have never seen a situation where we had negative GDP, but we weren't in an actual recession, and we didn't have unemployment increasing and things of that nature. So it's a really unique time right now, somewhat uncharted waters. The forecast for GDP is an increase in the third quarter of this year. That's in terms of what the economist consensus forecast is. I think it's around 1%, maybe 1.5%. And then fourth quarter should also be positive. The real question is, what are we going to look at for next year? We'll talk a little bit more about that. So as I said, we aren't seeing a recession in terms of jobs. And in fact, we're seeing really robust job growth. We're more than full employment. Full employment is considered to be 5% or more. And we haven't been above that in almost 2 years, well, a year and a half, essentially. So we're really seeing very good job growth. That circle at the top of 158.5 million, that was the number of jobs we had in February of 2020, right before the pandemic hit. We lost in 2 months almost 26 million jobs in 2 months. And it took us a little while to recover, but we did recover by March of this year. So 2 years to see a full jobs recovery. But the unemployment rate is very, very low. It's lower than it's been historically. And we, in fact, are having a lot of trouble finding labor right now. I've talked with many firms in the industry, and they're all seeing the same things. And we have data on that we'll show as well. So a lot of really interesting things happening in the economy right now. Another statistics I like to track, and this is called the labor force participation rate. This is really important because this is the percentage of workers who could work that are actually in the labor force. It doesn't have to do with unemployment rate. This just has to do with the number of bodies available to work. So we're at a fairly low number. It's lower than it's been in 2 decades. And the pandemic was a prime reason for it falling. You can see that very clearly. But we haven't fully recovered. And so we're still about a percentage point below where we were at the beginning of the pandemic. And we were on an uptick in terms of the labor force participation rate at that time. The reason it had declined prior to that is because all of the baby boomers were retiring. So they're available to work, but they're not working. And that's understandable. Many of them took early retirement during the pandemic. We lost a lot of women in the workforce after the pandemic that have not all fully come back. And there's a really interesting statistic that came out about a month or so ago from the Brookings Institution in Washington, D.C. One of their economists took a lot of different factors and calculated an estimate of 4.5 million people who could be working, aren't currently working because of the lasting effects of COVID on their health. That's a lot of workers. So that's a real prime driver right now of why we see this labor force participation rate low, and it's just not climbing. And this is something we really need to see. We need to get more workers back in the labor force, and we need to continue to expand the pool of labor so that we can take some of the pressure off of the wages that we're seeing. All right, so inflation is the other big news item right now. And there is a little bit of good news here. You can see that it's kind of hard, but underneath that box there, you saw a peak in June of this year. That was when the inflation rate year over year hit 9.1%, the highest it's been since the early 80s. And since then, the Federal Reserve has been aggressively ratcheting up their rates for the overnight lending, and that trickles through the economy and increases borrowing costs. So that is starting to have an effect. But once you have inflation surge, like we saw it surge all of this year and last year as well, it is slow to get it to come back down. So we were at 9.1% in June. 8.5 in July, 8.3 in August, 8.2 in September. You can see it takes time for it to come back down.
Inch by inch. But Joe, this, if I'm correct, is all items, right? If you look at food, if you take food and energy out, then it's actually going up. Is that right? What I've been reading?
Yeah, that's right. So that's kind of what the Federal Reserve is also looking at. And we see that a lot of people are saying, no, stop the interest rate increases. Don't be so aggressive. We're having a 750 basis point increase every meeting. And so what the Fed is looking at, though, is that core rate of inflation that takes out the volatile energy prices we've seen over the last 2 years, really, and the volatile food prices we've seen over the last year. And that core rate is still, it's higher than it's been in the last 40 years. So they're still concerned about inflation, and they're going to keep ratcheting up rates. I expect they're going to go anywhere between 4.5% to 5% before they let off the brakes. And right now we're 3.25 to 3.5. They kind of have a range that they target. So I think we're going to continue to see increases in borrowing costs because of the Federal Reserve's policy that they will be implementing. Now, inflation is expected to come down. We're seeing more and more information that shows it will be coming down. But again, it takes time. So that's the key. Now, from our sentiment survey, this is the survey that we conduct among AE firm executives, ACEC firm executives, and we have over 600 respondents every quarter. So this is the most up-to-date information. It's barely a month old. And the executives are telling us we're still concerned about inflation. Not only the concern about the effect it will have on our own finances, but we're now seeing concern that it will eat away at the positive impact of the IIJA. And we are, in fact, seeing some indication of that. So I think the concern is warranted. Now, we've been tracking this inflation concern regarding firm finances for a year, and we're seeing that it did jump up quite high from the first quarter of this year to the second quarter. And that's when everybody realized, oh, wow, yeah, we have an inflation problem. And it jumped down a little bit in the third quarter, but it's not come down from there. It's holding steady at a very elevated plus 72. So this is what we call our net rating system. For those of you who aren't familiar with it, we take the positive responses and subtract the negative responses. In this case, the way we worded it is concern over inflation. So a positive is bad. You can't have higher than 100 and lower than a negative 100. So again, this is pretty high. It's very high in my opinion.
Yeah, and this is one of those questions, Joe, to your point, where we want the number to be lower, right? Most of our sentiment questions that we're asking, we're looking for a higher positive number. This is one where we're wanting it lower. I was just going to comment, last week at the fall conference, we had a great panel discussion about this topic in particular. And the panel had some really interesting perspective because it was a very diverse group, right? So we had a small firm that was almost 100% public work, and they felt kind of very insulated from the bump they're getting from IIJA, and we're not as concerned as maybe these numbers reflect. We had a mid-sized firm that was like almost all private work, right? And they had a lot of concern. They were starting to do some contingency planning and concerned about the inflation issue and the job workforce issue. And then a larger firm that was kind of more of a 60-40 split across public-private. And they were really kind of taking a long view, a little bit more wait and see approach. So I think it really is impacting our members very differently, depending on the size of their organizations and the type of work that they're doing. And we saw that really reflected in that panel discussion last week.
Yeah, we also see it in the data. I think that panel was excellent because of how well it is representing the diverse views that we're seeing within this survey data as well. I think inflation is going to continue to come down. We're going to continue to see increases in borrowing rates. But once you have this level of inflation, even for a year, it really throws a monkey wrench into things because every price that you see has been reset now. And firms that have long-term contracts, they're going to be struggling with some of those escalation clauses if they have them built in that are generally about 3% based on our survey. So definitely a concern, but I do think the Federal Reserve is taking the appropriate actions. It should have started sooner, but that is just the way history has unfolded. And so I think we're going to see inflation coming under control, just it's going to take a little time. And here's the real world impact of what the Fed is doing. We always say borrowing costs are increasing, the Fed is raising rates. What does that really mean? Well, this is a great metric, and this is why it's used, because everybody can relate to it, and it's mortgage rates. We all know what mortgage rates mean and what they are, and we know that when you have increases, it increases the monthly mortgage payment that you have. And this is one of the prime ways that the Federal Reserve can slow down the economy, because so much of our economy is built around housing. And what we're seeing is just phenomenal increases. We saw a bit of a relief over the summer. You can see there from June to August, but since August, it's just continued this very steep climb. We're hitting new highs every week. And this was just from a couple days ago, October 21st. This is the Mortgage Bankers Association tracker. So we're up above 7%. And if you think that, as I do, my opinion is that the Federal Reserve will continue to increase rates, maybe another 1.5 percentage points, maybe even higher. This number could go up to 9, maybe even 10%. We haven't seen interest rates like this for mortgages since the 80s. And I thankfully was too young to remember that. So this is, again, this is a generational change that we're seeing right here. And once the Fed gets things under control in terms of inflation and they see the job market start to ease up a little bit, I'm not sure what will happen at that point. If we're in a slight recession, I don't think they'll reduce rates much. If they've overshot and we head into a bigger recession, they're going to have to pull rates back. So I think this is a big unknown, and it's a significant issue, because if you have borrowing costs, if you see ahead that inflation may moderate, but your borrowing costs are going to continue to be high, this is all something you have to plan into what you're doing and the work that you're doing. All right, so that's the end of the section. Daphne, do we have any questions from the audience, or should I continue on?
I don't see any questions right now, but please feel free to add them in the chat and we'll continue on. We can always come back to any questions on this section if we need to.
All right, so let's go into how is the industry doing right now. And the first thing I want to share with you is our sentiment tracking data. So this is the data that we've been tracking since we started the sentiment study in the fourth quarter of last year. And there's two really, really important takeaways. One is you see the condition of the US economy has continued to, the perception, the sentiment from firm executives is that the US economy is doing less well. Every quarter it's declined. And then we had a bit of a surprise in the fourth quarter here. We saw it rebound to a flat 0. I was expecting to see continued negative numbers here, but we've rebounded slightly. And so that's good news from that perspective that, hey, maybe the economy isn't as bad as we think it is. Regardless, the second point is the ratings, the net rating for the industry, as well as the firm's finances, has been very, very strong throughout the last year. So there's been this concern that the US economy is getting worse, we're having problems, but yeah, the industry's fine, my firm is fine, we're not seeing problems yet.
Well, Joe, the thing that is really interesting to me about this, and I guess we'll see what comes in the coming quarters, but to your point, we've got over a full year now, right? And if you go back and look at the first couple of quarters of sentiment that we did, we asked this question, how are you feeling now? But then we asked the question, how are you feeling what is it's going to be like in 12 months from now, right? And all those 12 months from now sentiments, the numbers were just declining, not just for the economy, but for the industry and for the firm, right? But as you can see from this slide, all along, it has stayed very optimistic and positive for the firm finances and for the industry. So each quarter, people, I think, are worried about, oh, yeah, in 12 months, it's going to be really bad. And so that's what those numbers reflect. But right now, like you said, it's good. It's good. My firm's good. The industry's good. So I'm really interested to see what's going to happen, in the coming quarter. But it's kind of an interesting dynamic. And we talked about this before on the last call about that self-fulfilling prophecy. And so we want to be careful we don't find ourselves in that situation. But I'm happy to see the economy at least coming back to a ground zero.
Yeah. And there's a lot of good news that we're about to talk about in terms of our industry. So I do think firms should be measured in their response to what's happening in the economy around us outside of the industry, because we still have a lot of very, very good news within the industry. So one of the things I like to show is this breakdown of current sentiment. And this is for the firm finances. You see that in the upper left block there, firm finances. And there's a couple things that I always like to point out for those of you who are new to this series. The regional breakdown is here if you want to look at that. What we tend to see, though, is it kind of goes up and down, up and down. There's no real trends. We don't see that there are really any meaningful statistics coming out of the regional data, but sometimes there are, and we have that information. So if your firm is based in the Northeast or in a certain area of the country, you can at least look at how are other firms feeling about the industry, their finances, et cetera, and you can benchmark how you're feeling against that. We also have firm size. This is the one that's more important. We found that this one tends to be giving us a lot more information. It tends to be showing us more trends. And what we see are two things. One, smaller firms, those 1 to 25 FTEs and 26 to 50 FTEs, those tend to have less positive feelings on almost every metric. And it makes sense when you compare that to larger firms. Larger firms have bigger contracts. They have just a lot more they can do in terms of finances. Smaller firms have shorter payroll windows. They have shorter horizons in terms of, hey, we're good for the next 3 months, but a larger firm might, yeah, we're good for the next 3 years. So we look at those smaller firms to really understand what's happening underneath those top line numbers. And right now, again, we're seeing very solid numbers, very high at 76 plus, 84 plus. And these numbers actually came up in the last quarter. So this is all showing very healthy signals from the firms in our industry. And the reason those 1 to 50 size firms are so important is they actually make up about 75% of firms in the industry. So that's why we like to look at these numbers and see what's going on. If we're seeing declines in those smaller firms, that could be something that signals a warning sign. All right, so as I said, more of those types of charts are in the full report. We also have a lot of information on each of these sectors. So I circled in blue the top performing sectors right now in terms of sentiment. And we have private market data that actually backs this up, that is also produced by the Bureau of Labor Statistics and Economic Bureau of Analysis. And we're seeing that in terms of transportation, both roads and bridges and airports, very healthy, very strong numbers there. Water and wastewater, energy and utilities, and even healthcare facilities. And they've all increased over the last quarter. Even those areas that have seen some declines in the last quarter are still very healthy. with a couple exceptions. If you look at the justice sector, that's not doing as well. It has not been doing as well since the beginning of the pandemic. We also see convention centers, sports facilities, these places where massive numbers of people gather. That also has not done as well, but we're starting to see that improve. We're starting to see those numbers come up a little bit. So we'll see what happens there. But again, most of these sectors are doing very, very well right now, and at least half of them are seeing increases.
And Joe, if I remember from last quarter, these were all negatives, right? So the quarter over quarter was all negative. So the fact that half of them are improving, I think, is a good sign.
Yeah, that surprised me again. I think we're starting to see maybe a turning point in some sense, that we thought it was going to be worse than it is. It's actually not. Maybe it's not going to be as bad as we thought it's going to be, even next year. And again, we'll take a look at the future in a few minutes. But there are a couple areas, residential land development, that has been negative. You can see it's going down. I mean, we went at plus 72 in the first quarter. We're down 31 points. So that is definitely a sector that is on the decline right now. All right, we also like to look at backlog. And again, we have this broken down by region and firm size as well. But what's interesting is just overall, our median number of months of backlog has risen by 20% since the beginning of the year. That's really, really significant and very good. To move the median, which is the midpoint, is very difficult to do, especially when you have 600 different firm executives reporting their backlog numbers. So this is very strong news. And just to give you a little bit of historical perspective, when we did our research around this during the pandemic, it suddenly fell to 6 months. So we have come back a long ways in the last 2 years.
I was actually, Joe, just for a little additional perspective, I was on a call last week doing a prep for a webinar that I'm doing with AIA and Deltec later this week. And so we were talking about backlog on that call, and I mentioned these numbers and shared this slide. And my colleague from AIA said that they're seeing theirs increasing as well. They're up to about 7 months, but she said they had burned through most of their backlog during the pandemic, or the height of the pandemic. And so they're, kind of happy to see theirs coming back up, but they're running at about 7 months on the architecture side.
Yeah, that's good news as well. I think that confirms sort of the larger industry look of the direction that we're heading. And here's that slide I mentioned a moment ago, that this is the backlog broken down by region as well as firm size. By region, there's really not much to talk about there, and it's been very steady over the course of the last 4 quarters. At the firm size level, it's also been very steady, but here's where we look at the small firms versus the big firms. And those small firms obviously have smaller, shorter backlogs. And that's why we look at them as that canary in the coal mine, a little bit of a bellwether for us. If we start to see those numbers decline in any area, that says to us, okay, something may be shifting here, but everything's very solid and very steady. All right, in terms of jobs, this is also a big concern, because 9 out of 10 firms are hiring. And we've seen that number stay pretty consistent. I know this chart's a bit messy, but if you look at the none, it's small, right? That's the percentage of firms who aren't hiring right now. And it's staying around 10% or so on average. So 9 out of 10 firms are hiring. The median number of job openings at all firms stands at 5. But what's really important is when we look at that firm size breakdown. This is where you really have to look at these numbers to understand how big of a challenge the workforce is right now. And it's continuing to be a challenge. What we see when we do the calculation on a firm by firm basis, we see on average 10%, 1 out of 10 positions at firms are not currently filled. That's a lot. Even if you're talking about a small firm with 10 people, well, if you have 2 of those positions empty, that puts a lot of pressure on the rest of the system, on the rest of the workers. And look at these large firms. They have a median number of 100 openings right now. It's really kind of crazy what we're seeing. And so this is a challenge. We need the economy to slow a bit, even within our industry, because this job, the job pressure that we're feeling is turning into wage inflation, and that's a real concern.
Well, and Joe, just to remind our viewers, for those of you who joined us last quarter when we released the Q3 results, one of the things we asked about related to job openings was why, right? Why do you have these openings? Are you filling new jobs because of growth? And that was the answer. 76% of firms had new jobs and growth opportunities. And then 60% were refilling or backfilling people who had left the firm. But the concerning thing is what I think you labeled the double whammy was, 47%. So almost half of all of our members are dealing with both of those issues, right? They're filling jobs for people who have left, as well as growth opportunities and new positions that they're bringing on. So a lot of openings, to your point, and concerning for those who are dealing with both of those issues.
Yeah, and at fall conference, the panel you were mentioning, Daphne, one of the panelists, the large private sector firm, he indicated we have had 60 people leave in the last year, and we've hired 60 people. They're just barely keeping up with that turnover. So I think that's a really good anecdote of the pressures that we're facing right now in terms of jobs within the industry. And what we're seeing is that it's having a real impact. Half of firms, for the last 2 quarters, we've asked this question, half of firms have said, we've turned down work because we don't have enough people to do all the work. That is a big concern because we can't grow the industry to the extent possible if we don't have the labor and we don't have the workers to perform that work. So this is a real challenge, and we're going to keep tracking this number. And then we asked about what types of work are you turning down? This is a brand new question for this quarter. And there's some good news here, but some really concerning news. So many firms, 86%, say we're being more selective about the projects. That's not necessarily a bad thing. It makes your firm more profitable. You have better projects to work on. Not necessarily bad. We're turning down less profitable work, 61% of firms. Again, that's not necessarily bad. It's not great. I would hate to turn down any work if it's somewhat profitable. But what concerns me is 25%, 1 out of 4 firms say they're turning down good, profitable projects. So again, this is a lid. It's a lid that on our growth that we need to solve for. And I'm not sure we have a silver bullet right now. It takes time to train new engineers. It takes time to change policy to allow firms to bring engineers into the United States. So this is something that we're going to have to keep an eye on and continue to work through for the next foreseeable future here. All right, so what else does the future hold? Well, we know jobs are going to be a challenge here, but how healthy is the industry going to be over the coming 5 years? Again, we have brand new data for you that we're going to share with you. And this is from the economic update. Again, on November 15th, we have a full roundtable devoted just to the economic update. Lots of great information that you won't want to miss. But here's another teaser for you. We see that during this forecast horizon from 2022 through 2027, very, very good growth. Okay. In 2021 over 2020, we saw growth of almost 10%, and we're expecting to finish out 2022 with almost 11% year-over-year growth. So again, very healthy information and news for the economy. It does trail off toward the end of the forecast horizon to a more moderate 2 to 3%.
Hey, Joe, we do have a question that came in, and it's sort of tied to what we've talked about related to inflation, but I think ties in to this as well. And the question is, does this forecast reflect inflation or the impact of inflation? Is that already built into this?
Right. Good question. So what you're seeing here, the growth rates do not account for inflation. The dollars are real. Okay. These are real dollars. They're not, I should say they're nominal dollars. There's a distinction there. They're nominal dollars. And so you will see year over year increases in revenue. But we have actually calculated how much of this growth is going to be eaten up by inflation. It's in the full report, and it will also be talked about and discussed in detail on November 15th. And I can tell you that it is eating away at our growth. So the real output is not as good as it might appear, but I want to leave you with that teaser.
Okay, thanks, Joe. We'll have to wait till November 15th, or else go read the report now.
Read the report. It's in there. But yeah, that's a concern, and we've detailed exactly how much of this growth is going to be eaten away by inflation. And just my little hint, it's significant.
And so just one more question tied to that chart, Joe, before you leave it. Is this forecast strictly based on the estimated impact of the IIJA?
Yes. This includes the IIJA. In the report, we actually show without IIJA what this forecast would have looked like. And we are seeing a great deal of positive impact from IIJA. Over the course of this 5-year horizon, we're seeing an additional $132 billion in output. So that, again, that's over the course of 5 years, but 132 billion is great. That's a real shot in the arm to the industry. It also, though, the other side of the equation is we're going to need an additional 82,000 jobs above and beyond what we would have needed had we not had the IIJA. So there's definitely good news that the IIJA is supporting the industry. It will absolutely help the industry through any type of recession we might see next year. But as we're going to show you in a minute, that may be affecting some sectors of the industry more than the others. So here is what the IIJA entails. And this is just very high level, and this is billions of dollars. When it was passed, this is how much money was being earmarked for different areas. Transportation is seeing over half of that amount of money. And so it's not surprising, as we just talked about, that transportation is one of those sectors doing really well right now. And in fact, the best of all the sectors. But we also see water, we see and energy, the power grid. So, and those are two areas that we're now seeing on the sentiment survey, really positive numbers coming out. So if you're in these markets, then you're going to do fine. If you're well diversified, you should be fine. If you are solely in private markets, and let's say you're in commercial or land development, then I'd be very concerned right now. So this recession and the outlook is going to be very, very specific and different based on sort of what your firm size is, what industries you're focused on, and how diversified you are. So looking ahead, this is what you were talking about, Daphne, forward-looking sentiment, 12 months ahead. We see these net ratings for the firm finances at plus 31, for the industry at plus 12, and for the US economy at a negative 28. Now remember, currently the firm and industry ratings are in the 80s. So this would represent a significant decline in sentiment in 1 year from now. And the condition of the US economy as well is saying, okay, well, we might be bouncing back just a little this quarter compared to last, but still says, hey, we think there's trouble ahead. Well, let's look at the trend, because this is also really, really interesting. When you look at the US economy future sentiment, we also saw an improvement relative to last quarter. And what's really interesting to me is that when we look at the economic forecasts from economists, they're saying that we should be in a technical recession by the second quarter of next year. Well, if that happens, then the ACEC community was right in line with that prediction as of the second quarter of this year. It shows a huge negative dip from first quarter to second quarter. So we're really interested to see how this metric plays out over time, because this could be a leading indicator that gives all of us a heads up as to what might be coming down the road. Now, we also saw at that same time a huge softening of sentiment within the industry as well as firm finances from first quarter to second quarter. So again, we have to see, is that going to happen, or will our industry and the firms still do really well next year? My personal opinion, if you're just asking me what's your guess, Joe, I think we're going to see pretty solid numbers next year for the firms, finances, and the industry. I think we will see some negative sentiment in the early part of next year for the U.S. economy, but I'm hoping it's not going to be as severe as perhaps what the consensus might indicate. All right, we asked why are you concerned? If you have a negative opinion of any of those three areas, why are you concerned? And there's two reasons that really jump out. One is inflation and the rising costs of the supply chain and other issues. So that is the primary concern, and rightly placed, I think. Also, recession concerns. Again, I think that's right on the money. So I feel like the firms are in tune with what's happening around us. But there's other things that sort of are second tier concerns: interest rates, general economic uncertainty, workforce shortages, again, all things we know about. And then this other one, which is interesting, I'm not going to talk too much about it at all, but this political environment and uncertainty. So it's interesting to see how the world around us is affecting our industry and is affecting our firms. And I will not sit here and try to predict what's going to happen with the election, but there's obviously some concern about, what might happen should control of Congress change, should there be issues with the election process, et cetera. So something to just note. Here's the firm, the breakdown of the industry sentiment 12 months out. And here's where I have been telling you all, pay attention to these smaller firms. We're now seeing for the first time negative sentiment for the smallest firms, 1 to 25, for 12 months out. So this is where I'm saying, okay, we really have to take a good look at what's happening with small firms, because that is the majority of the industry in terms of the firms themselves. So this would indicate that, smaller firms are getting more worried, and they're definitely more worried than the larger firms. Interestingly, we saw this big drop in the 201 to 500 firms over the last quarter. I couldn't really tell you exactly what's going on there. Sometimes we do get a little noise in the data. It definitely is sort of outsizing the trend here, but something to watch. There might be something going on there as well. And we did see improvements in the sentiment for other firm sizes. So again, a little bit of good news, bad news, perhaps. And when we look at those industry sectors 12 months out, this chart's a little different. These numbers are much, much lower. And we also see particular segments. So commercial real estate, -29, residential land development, -39, convention centers, -25. So we are definitely seeing a lot of concern in certain sectors, but other sectors are going to hold up just fine. So those areas where the IIJA is affecting in terms of transportation, water, energy, and utilities, those are all top performing sentiment indicators 12 months out. Also, concerns about backlog. Well, they're all positive. It's less positive than it was earlier in this year, but we still see that nearly half of firms believe that their firm will have an increase in backlog over the next 12 months. We're seeing more firms that think they'll see a decrease, but we still have a really healthy outlook here. In any normal year, I would say a +25 is very good. Any positive number is going to be good. It's just not quite as robust as earlier this year. So I'm not too concerned about backlogs overall, but again, I'm going to keep an eye on what's happening with those smaller firms.
Well, I think, Joe, just to that point, it speaks to your comment earlier about seeing what happens in early 2023, right? Q1, Q2. Is that where we're going to see this drop off that was anticipated a year ago? Or is it going to come back and stay, healthy as it is now.
Yeah, I mean, all signs within the industry, from the sentiment data and from the external data that we're tracking, are pointing to concerns in the second and third quarter of next year. So that's really going to be the time to watch. See what happens in the last 2 quarters of this year. If the numbers are better than expected, that's a good sign for next year. If the first quarter of next year is worse than expected, perhaps the rest of the year won't be as good and maybe more negative than we were anticipating. So those are a few things to keep your eye on over the next 3 to 6 months. All right, so here we have hiring. We continue to see extremely strong hiring expectations. Firms believe that there's not going to be much easing in terms of their labor shortage. And in fact, even if the economy slows, I do believe we're going to continue to see challenges hiring within the industry, not just because of IIJA, but we've had a historic shortage of graduating engineers in this country. And our policy for H-1B visas has not become better, from our perspective in needing to hire workers. So this is a real challenge that I don't think is going to be solved by any type of recession. This is something more structural that we're going to have to really take a harder look at as an industry. And I know, Daphne, we're talking about a lot of research that we might do and some other policy efforts that some of our other colleagues are working on as well.
Right.
So that's something we're going to keep working on and keep watching. Hiring trends by firm size, also very, very strong. A little less positive for those smaller firms, but still very positive across the board. So again, I don't think we're going to see any let up in the job market here. Might be a little better next year, but I think it's still going to be a very tough environment. And here's something we wanted to share with you all, a couple slides. We like to ask about what we call hot button issues or hot topics in each of our quarterly sentiment surveys, just to get some additional information that might be something you're wondering about. So we haven't talked about remote work since probably early last year when the pandemic was still raging. And we wanted to update you on what are firms doing in terms of their remote work policy. So a couple interesting things to note here. First, 97% of firms report that all of their offices are open for work now. So we really have come back around into a recovered situation in terms of people being able to interact with each other. So that's really good news. But what's interesting here is that very top bar, 17%. We are requiring all employees to work in the office every day of the week. And even if you look at the second bar, we're requiring some employees to work every day. Those are pretty small. So maybe 1/5 to maybe 3 out of 10 firms have a pretty strict policy right now. Well, some information that I dug up from the Bureau of Labor Statistics from 2019, before the pandemic hit, it showed that only 25% of workers had ever worked remote. Now we're seeing the complete opposite of that. Pretty much everybody, 80% of workers have a very flexible remote work situation. So interesting how the pandemic has changed the way we work and where we work. And we're not seeing any real movement yet in a different direction. So I think this is something we'll continue to sort of probe on every now and then to keep you all updated on what your peers are doing. And then we also asked, of those who are allowing some flexibility, how many days, if any, are they requiring employees to be in the office? We still see about 1/5 of firms say, look, it's pretty flexible. We're not requiring a minimum number of days in the office, but there's a lot of variation here. So about 1/3 of firms say that they're requiring at least 3 days in the office. And anecdotally, I hear that a lot, especially in the DC area where I'm based. It's 3 days, or 3 days, or 3 days. So that seems to be where a lot of firms and companies are trying. But there are still firms and other organizations that are saying, no, you got to be in 4 or 5 days a week. So real diverse approach right now in terms of the required days in the office, but a much different approach in terms of the flexibility of remote work right now. So very, very interesting to see how things have changed in 2 years. All right, so those are the slides we had for you. I'm just going to give you a few wrapping thoughts here. We do see that unemployment is still at record lows. We have buying power that exists because it still does exist, but it's being eroded by inflation, and that's a big concern. From other research we've conducted in the last year, we know that the industry is paying about 10% more for new hires than they did last year, about 7% more for people who have been with the firm for more than a year. So we are seeing inflation pressures pushing wages up, and the wages are really a reflection of the job the supply and demand more so than anything else. We're going to continue to see rising prices for consumers. How far and how fast is the Fed going to react? They've been reacting very, very quickly. Will they keep going for too long? That's the real question here. The housing market has definitely started to cool. I was just reading some stats this morning, new information that's come out, where we are seeing a reduction in the growth rate of prices. We're seeing more reduction of prices for homes that have been on the market. About 20% of homes in September that were on the market had a reduction in their price. We're seeing slower growth rates in a lot of markets. We're seeing negative rates along the West Coast where the markets have just gone way high, way too fast. So that's definitely starting to come about, and that's good news. We need that. It might involve some pain for some people, but we have to do that to get the economy back on the right track. And will we hit a recession or not? We might. If we do, we currently think it'll be a mild recession, but there's still a lot of unknowns, and we have to wait and see how that works out. And as I said, keep an eye on these quarterly GDP numbers for the next 3 to 6 months to get an indication of what's going to happen next year. And finally, we are in a good position as an industry because the IIJA has absolutely been a shot in the arm for the industry. So I would much rather be sitting here trying to figure out how are we going to find enough people to do the work than say, hey, we don't have enough work for the people we have. So sometimes the good problems are better than the bad problems. With that, Daphne, that's all I have. I'm happy to answer any other questions that might have come in.
I did have one question come in about the next session, so I'll just take that one, Joe. It's going to be November 15th. That's the session Joe was referencing on the economic impact and the forecast, where we'll have our chief economist along with Joe diving into all the details of that report. So that report is available on the Institute website. Actually, Joe, if you want to go to the next slide. Just again, thank you to all of our donors for making all of this possible. And then the last slide has the QR code, and I think that will get them to not only the sentiment report that we really dove into today, but also to the economic impact and forecast report. So both of those reports you can get through this QR code. We'll just leave this up for a second so you can grab that if you'd like. And register for the November 15th session. That'll be again at 12:30 Eastern, same as today. I don't see any other questions, Joe. So I think with that, thank you all again for joining us. We look forward to seeing you on the next Future of Engineering Roundtable, and hope you have a safe and wonderful day. Thanks, Joe.
Thanks, Daphne. Bye-bye, everyone.